one area of the market where investors are putting money to work right now are those value stocks. How long can that rally last? Brian Levitt joins us to talk about that. He's global market strategist at Invesco. Brian, good to see you again. Welcome back.
Good to be back. Thanks.
You're a bit skeptical about this value-led rally. Why?
Yeah, I mean, typically value needs a catalyst in order for it to outperform on a persistent basis. And so this value rally, in my opinion, is the result of very weak economic activity in the summer and a market that had gotten very bearish and even inverted the yield curve. And so what you're seeing is a recovery, rates up, the yield curve normalizing. You should expect value to do well in that type of environment. But beyond that, you would need a catalyst. And that catalyst would usually be the United States moving to a new, higher, sustained level of growth. I'm skeptical. I don't think at this point in the cycle we're moving to a new, higher, sustained level of growth. I think we're normalizing back towards trend. And in a more trend growth environment, I would still call that a slow growth world. Investors tend to favor true growth assets.
So these defensive issues that have done well recently, the industrials and the financials and some others, you're saying maybe be careful with those right now. Is that the idea?
Well, it's not that they won't perform well. I think they'll perform fine. It's just whether growth is going to outperform value. So I think the markets are likely to trend higher, but leadership is likely to revert back to the more growth-oriented parts of the market. I mean, again, value cycles, to unlock value, I would think you would need better growth, which means rates up significantly, a much steeper yield curve. We're in an environment where rates backed up from very dire levels. The yield curve has steepened a little bit, but in order to really like value, you would have to think that that trend continues. And in my mind, this is still a slow growth world, and that's going to favor true growth assets.
And if memory serves, value stocks tend to do well near the end of a market cycle. Do you think that's what's going on here?
I mean, no. I would think value would do well at the depths of a recession into a recovery. So this is not, that you've had growth stocks run for a while and the market cap breaks and then the more value-oriented parts of the market do well. This is a recovery off of pretty weak levels in the summer. This is not the end of the cycle. If anything, I think this cycle is going to go on for far longer than most people suspect because growth is reasonable, the Fed's easing, there's no real inflation. So I don't think the cycle's ending anytime soon. This is just a value-driven recovery from pretty rough levels in the summer. Right. In order for value to persist, you would need to get to a new, higher, sustainable level of growth. I don't believe we're getting there.
Very good. Brian Levitt with Invesco.
Thank you.
Again, Brian, thanks for joining us.